Hi, guys, and welcome to the 44th episode of the weekly trading wrap up, WTW, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we start with a picture of the S&P 500. Okay, this is the market. We've come a long way since the tariff scare that knocked the market down almost 20% in April. And now we have come from those lows all the way to the highs of today, which is, finished at close of, the close of the high, yes. It closed at a high if you look at just the closing prices. So this arrow denotes Monday, then we have Tuesday, Wednesday, Thursday, Friday, and Friday we finished at all-time highs at 263.70 on the SPY. Okay, so of course we first look at the technical picture, and we know that the technical picture is bullish. Very little drop. I mean, even if we go back to the lows of April, we barely had, not even a 5% drop, maybe 3% drops, nothing to scare anybody. But this entire time, everybody was scared. So it was a very low vol climb, super bullish. The technical picture is super bullish. And that's where we stand. However, this whole time, we always look at sentiment as well. First thing we look at is the CNN Fear and Greed Index. We're at the greed. We were at neutral last week, and now we finally moved into greed. We're getting there. We can still go to extreme greed. We're not quite there, but maybe we're close to maybe a little bit of a correction. Not yet. Still very bullish. But another surprising thing, but not really, the surprising thing was the opposite. But the AAII Investor Sentiment Index, we always look at it, and what I mean by it was the opposite, is for months and weeks we've been very bearish and not even average bullish. You can see the historical averages here at 37.5 for the bulls and 31 for the bears. Consistently, we've been above the average in terms of bearishness, and consistently, we've been below the average in terms of bullishness until this week. Finally, we're starting to see the bulls come out, 41.7% bullish. That's big in 1 week. And this thing dropped, and this thing, meaning the bearishness, dropped to 42%. It's still very high. People now are off the sidelines and they're picking their sides, bullish and bearish. However, just 1 week, I don't think it's enough to really turn the tide. We would need we had before here, maybe 4 weeks, 5-6 weeks of extreme bullishness for there, in my opinion, to be some kind of meaningful drop. I don't know, maybe in October, November, who knows. But we're still, it's there. We're getting into the bullish camp. People are starting to come aboard. Retail, that is. This is retail. Retail's starting to come aboard, starting to buy some calls yet. Still not fully greedy, but just starting. Now we're getting into the point where this low volatility rise might get to the point where we're going to see a more meaningful correction, at least 5%. Not yet. Now we still have a very strong bullish technical and sentiment picture. Okay. The second part of our session is always the macro. This week, very light on macro. Initial claims. Remember last week we had a mental note. Watch it, because now people are starting to file for unemployment and claims. Well, back down. Now that was an anomaly. Okay, so now we're back down 231,000 for the weekly initial claims. So we're not there yet, even though the jobs are not stellar. They're in 50,000, 70,000 jobs. People are not filing for unemployment yet. Okay, so, that's the one thing that we should always keep our eye on. And the other thing that happened this week in terms of macro, I guess, is the Fed meeting. And this was the day, the Wednesday. You can see the candle. I don't know if you can see it, but this wick, people started getting scared, sell the news, but nope, the market renewed its bullishness. So the Fed news of more rate cuts seems to be bullish at the moment. Okay, and you can see like it has a meaningful impact because the Fed Watch tool went from like now we're looking at October, but in September it was a cut to 4% or 400 basis points. That's the level that we're at. So there was a cut, but for October they're predicting a 92% chance for another cut. So the rate will go to 3.75. Okay, so it's almost a certainty. And in December, 80% chance that we're going to cut twice. Okay, so all of 2025 they're pricing in 2 cuts now for sure. Unless something changes, I don't see why, but for sure 2 cuts because the Fed is leaning towards protecting jobs instead of inflation. Now, the other side of the equation is the inflation thing. Now, they're cutting. Is that inflationary? Well, what does the U.S. 10-year have to say? Well, the U.S. 10-year yield rebounded. Despite a couple of cuts, planned for 2 more cuts planned for this year, it's going up. We're still at a high level of 4.12%, okay? We're still in this, huge sideways consolidation. Rates are staying high. And the reason that is because after the Fed, which is this arrow here, can you see it? This arrow here, maybe they're also afraid that inflation is going to come back in the future. So this is not a deflationary type of move yet. This is more like the market is probably going to, that doesn't mean the market doesn't go up. I mean, markets go up with inflation. I mean, just look at the Venezuelan market. It was one of the best performing markets when they went into hyperinflation because, the economy has real goods and those go up too with inflation. But when you have yields this high, but on a nominal basis, it's not going to be high, okay, like the market that is. So the market might go up 5%, but if inflation is 6%, you actually lost 1% in purchasing power. So, yields are still fairly high. Not out of the woods. Like we're not there yet. I don't even want to say the word, but stagflation. Let's get rid of this arrow. Stagflation is not here yet because we're not, people are not losing their jobs and we don't have runaway inflation or anything like that. But we're veering, the market is sort of suggesting that rates are going to be higher. We're seeing inflation coming in the future, although we're still happy right now. So maybe it's something to put in the back of your mind for like months later, or maybe a year, that we could get into a stagflationary environment. And this all ties into gold, okay, because gold, as you can see, still does well, hovering this whole week, going to the highs and hovering this whole week, especially. Like it suffered a bit after the Fed, but boom, once yields are staying high, and which means the bond market is scared of inflation, it's going to keep a bit under gold and even silver. Okay, silver new highs, closing highs. Okay, so I'm still overweight precious metals for this particular reason. I mean, there's a lot of ways you can play this environment, but stick with what's tried and true. You know that gold is there fundamentally, it's strong, and you should have some exposure. If not, you should be overweight. You don't have to be crazy, but you should be overweight. Okay, so that's it for the macro. Okay, this is the implications of the Fed cut is that there will be more cuts, as we saw in the Fed Watch tool, and it's not necessarily good for inflation. That's why yields are still high. Okay, so in the third section, let's talk about things that interested me this week. A couple things. First, let's review our 2 trades that we shared on Twitter. We set up a complicated, fairly advanced option structure for Mara holdings. Okay, we did it while it was consolidating around here. Okay. And this week we saw Monday, Tuesday, Wednesday, Thursday, Friday, Mara started breaking out of this consolidation period, this consolidation area right here, if you will, with this candle. This candle, which happened on Tuesday right before the Fed, is the breakout. Okay, and you can see a much higher volume than the average. Okay, so you can see clearly this candle is the Tuesday candle, and the corresponding volume is much higher. So this is indeed a breakout. Let's hope it continues. Okay, and the reason we played this, it was a Bitcoin related play because Bitcoin broke out to highs back in July, and I was waiting for a retest, and it happened. The retest happened in beginning of September, and that's what we entered our trade in Mara as a proxy Bitcoin play. Okay, so let's revisit this play. This is the options tree, options structure for our Mara play. As you can tell, we did it on, we took the January expiry, which expires 119 days, and what we did was we well, first of all, let me explain it because I don't want to I don't want to jump too far. But here in the middle we have the strikes, we have the call structure here, and we have the puts here. Okay, so we decided to sell the 13s puts and buy the 10 puts. This is like a bullish put spread. We collected a credit here. We sold it at 87, bought it at 38. I mean, we didn't do that. This is a picture of. That's not the price we paid. Okay, this is a picture of this structure that we did as of Friday, September 19th. Okay, so we sold the 13 puts, bought the 10 puts, bought the 18 calls, and sold the 25 calls. Okay, as you can tell, Mara right now is at 18. You saw it before, it was running from around the, where was it? Let's lower this. We were at here consolidating around the 15-16 level, and then it broke out. Okay, so just to get a picture of where we're at, we're these prices right now as of Friday, where it's trading around 18.30. Okay, so this structure right now that we have, you can go to the previous Mara WTW report, and you can see why we did it and all the explanations. I'm not going to go through that right now, but this is just an update to see where it was at. As you can tell, this whole structure are represented by these legs. You can see sell the January 13 put, buy the January 10 put, buy the 18 call, sell the 25 call, and if you were to do this right now, the bid-ask spread is 128 to 140. If you recall, we were buying it at around the 50-cent level. Okay, you could have gotten cheaper. Actually, it was in the rough 40s, but let's say worst case scenario, you could have bought it at 50. So we're about almost triple. Okay, we almost tripled our position in like a week. This whole week. So this is a good move. Okay, going forward, what I expect to do is, it's going to take some time because this is January, but we'll see. Okay, like we will manage it as we go along. But what I'm envisioning right now is, as the price goes higher, let's say it goes in the 20, 21, 22 area, stays there for a while, I'm looking to buy back this put. Okay, maybe at 10 cents. 5 to 10 cents. So we will completely de-risk this position, because right now the maximum loss is $3. If it ever falls down to $10, we will lose $3 on the amount on per share. So we did 100 shares minimum. If you did that, we did a little bit more, but if you did 100 shares minimum, it would cost you $300. Okay, so we want to be able to de-risk this side while keeping this. Okay, so as we stand, this is very good. And we're going to just let it marinate and hold, and manage going forward. And I will keep you guys up to date on this position as we keep going forward if there's any developments. Okay. So that was the Mara update, looking very good. The other thing that we did was the UUU trade. Okay. As you recall, we entered the UUU trade on this day here. Okay. And the UUU trade, let's see if we can recall what we did here. Yes. I don't know if you guys can see it, but this is the UUU trade. UUU, the October, we got the October series. Okay. We sold the $8 put, bought the $6 put, bought the $10 call, sold the $15 call. Okay. And now you don't have it because it's closed. We don't have the prices because it's closed. But as you can see, you don't have any prices here. So what we did, well, let's go back because I want to show you a little bit of how even when the worst case scenario happens, especially when with this, not the worst case, but a very bad case scenario happens, because we set it up correctly, we didn't lose that. We didn't lose. Okay, so what happened was when we bought it here on Monday, the 18th of August, the next day the stock went down 20%. Okay, so it was testing our $8 put that we sold. Okay, so this $8 level right here was being tested. Okay, thank God the next day didn't go because I was ready to manage it. But as you can see, after that, fundamentals kicked in and we went up higher. Okay, so it was in danger of us realizing that $2 loss, because if we sold the $8 put and bought the 6 put, our loss is capped at $2, okay, per share. And as you can tell, if you go back to the trade, we did 2 to 1. We sold 2 puts and bought 2 puts versus buying the $10 call and selling the $15 call. We just did one, and the ratio was 1 to 2. Okay, 1 call spread bought versus 2 put spreads sold. Okay, it's a bullish trade. Both ends are bullish. So this tested us. However, the fundamentals kicked in, and now we're back up to the 1488 level, which, as you can see, it's right at the 15 call that we sold. Okay, so with this structure, our maximum profit is going to be this $5. So for every call that you have, you should have 2 puts. That call now is going to be worth, for one contract is 100 shares, so this will be worth 5 times 100. You're up $500 right now, or a bit less, and even less than that because we still have time to expiry. So you're not going to realize the whole 5 until the expiration. Okay, and the beautiful thing is, as we were recovering and UUU shot much higher around this level, it got us a chance to buy back these $8 puts. I think we sold them for around 45 cents each. I bought it back at 10 cents. Okay, and the reason we did this is that we entered this position nearly flat. Okay, it was a near flat trade. Okay, almost not risk-free, but we put almost no money down to enter this trade. Maybe we spent 10 cents, I can't really remember. Okay, but by buying back this put, which was 2 to 1, the cost now of this structure became like 26 cents because we bought it back at 10 cents. Okay, and the reason that happens is because we did it at a 2 to 1 ratio, plus because you bought it back, you didn't let it expire completely worthless. You paid 10 cents extra from your original cost. So if your cost was like, I don't know, 15 cents and you paid 10 cents extra on this, it won't, because it's 2 to 1, so it'll be a bit less. So overall, it comes out to 26 cents full cost for this position, but de-risked. I cannot lose $2 anymore. I could only lose the 26 cents. Okay, and the profit is 5. So $5 profits, 26 cent cost. You know, that's a huge 5 times, what is it, 4? 20 to 1. If you realize the full profit, it's going to be 20 to 1. Risk return. No, what is it? Yeah, could be 20 to 1 or a bit less, maybe 18, 17, something like that. So this is what I hope to do for the previous Mara trade. We're going to get rid of this Mara equivalent, which would be at $10, and we can completely de-risk the Mara trade. Okay, although the Mara trade, we entered it at a 50-cent profit. We're gonna probably maybe buy it back at 10 cents. It's gonna end up costing us 60 cents, but no chance to lose $3. Okay, so this is more advanced because it'll expire in October, and because the price went higher. So this is looking very good, completely de-risked, and we're close to the maximum possible trade. Although time value, maybe we're at 70, 80% of the total maximum. Okay, So that is it for the recap of our 2 trades. They're looking very, very good. Hopefully we'll have more for you guys in the future. So this is the recap for the entire market. Bullish, no reason to not stay bullish. As you can tell, if we put the moving averages, you have the 10, 20, 50. Trading price is trading way above even the short-term moving average. I mean, this is a very, very strong bull market, and you want to stay positioned long until something starts breaking. Okay, so don't touch. Basically, what you want to do in this bull market is you should have your positions already. We've been talking about being long way back here. So you should be riding these positions. The best money is made by riding out a bull market and not tweaking it too much, okay? So that's it for this week. It's been a beautiful week so far. Beautiful month, beautiful couple months, beautiful 3 months. And looking forward to seeing what kind of beauty the markets can give us next week. Later, guys.